The European crisis is off the boil, but one thing that is still a problem in Europe is unemployment. Let's go now to Brian Blackstone in Frankfurt to talk more about just what is happening with unemployment and with economic growth. Brian, we had some not too good figures on the unemployment front out yesterday out of Europe. What were we seeing?
Well, you're basically seeing two big problems in Europe. One is when you look at the Eurozone as a whole, unemployment is going up. The unemployment rate went up to 10.7%, which is the highest rate since 1997. But even a bigger problem is that across the Eurozone, you're seeing these huge divergences. You have an unemployment rate of 4% in Austria, 23% in Spain, and you've got one central bank that has to basically create the right conditions for countries at these two extremes.
Brian,
Germany's another one that's doing really well.
Did you just say 23% in Spain?
23% in Spain, and the youth unemployment rate in Spain is 50%.
50%.
So it just gives you a sense of the challenges these countries in Southern Europe face. And on top of this, you're going to get new austerity programs, which is going to mean cuts in the public sector, higher taxes, other government spending cuts. That's going to push unemployment up even further. So, and it's not just Spain. You've got 20% unemployment in Greece. You've got 15% unemployment in Ireland. So you've got this huge divergence between the north, countries like Germany, the Netherlands, and Austria that are doing fine, and Southern Europe, where they're really having severe recessionary forces in the labor market.
And Brian, part of that, this data, like we had some numbers on decreased GDP expected for this year in Europe. These numbers are going to provide fodder for people, in places like Greece that are saying these austerity measures are too much. They're stifling growth, and this is, further example of that.
Well, that it gives more fodder to the people in Greece. The problem is the people in Greece just have no choice. They're having these austerity programs imposed on them, and if you can't borrow money in the private sector, then you pretty much have to do what the other European governments are telling you to do, which is why Greece, despite all these protests, is continuing to pass these austerity programs. Now, the issue in Greece is just because you pass a law, it doesn't mean it gets implemented. And that's kind of been the real trick with Greece. But it really also gives a lot of fodder to the critics outside of Europe that say the Eurozone has this wrong, that they should be finding ways to stimulate the economy, especially in stronger countries like Germany, in order to provide more tailwinds for the countries in the South.
Of course, Brian, it's tough to see. I understand those arguments, and you hear them, and you understand the pain that people are experiencing, but can Europe really afford to go out and try and ladle on more debt or just print its way out of this problem? It seems at some point they are so far in the hole that they just have to face up to the reality of it, which also might be good for us here in the U.S. to recognize.
Well, that's kind of the dilemma you have here right now. It's that you're right, for the countries like Greece and Portugal, they have no choice. Their debt burden has gotten so huge that they have to find a way to bring the deficit down significantly, or else people in the financial markets just don't have the confidence to lend them money at some point down the future when they are out of these bailout programs. But for Europe, the issue hasn't always been that the Eurozone as a whole has a huge amount of debt. The deficit in the Eurozone is actually quite a bit smaller than it is in the US and Japan and the UK. The issue is, how do you get money from the rich countries like Germany that are running almost balanced budgets and channel it to the countries like Greece or to Spain to help them kind of get some kind of investment-led economic growth? The issue is Germany doesn't want to lend them any more money. It definitely doesn't want to give them any money. And so you've kind of got this divergence, not just in terms of the economy, but in the debt dynamics that really are proving difficult to solve.
Brian, can we just jump in there where we're seeing the video? It looks like there's a search for some office supplies going on right to your left or right.
We're wondering if they're trying to find some extra funds for the EU over your shoulder.
They put me in the corner here.
It's sort of like, well, better than the box that the EU is in at the moment. Brian, one thing here, with unemployment so high, and like you say, there's a lot of divergence between, say, the richer nations in the north, poorer nations in the south on the periphery. But this is really a challenge for the ECB, because normally if you're talking 20% unemployment, it'd be like, well, let's take rates down to zero. The ECB hasn't gone there because of inflationary fears.
Well, exactly. I mean, for the ECB, it's a real dilemma because countries like Spain or Italy or Greece, they need even more expansionary monetary policy, whether it's cutting rates closer to zero, quantitative easing. They need a huge effort by the ECB in order to help their economies. The problem becomes in a country like Germany, where you have record low unemployment, where you have a manufacturing sector that, even though it's weakening a bit, is still growing. If the ECB were to take these big, expansive steps to stimulate growth, you could create inflation and asset bubbles in Germany. And in Germany here, you're talking about a very conservative country when it comes to how their monetary and fiscal policies operate. So really, the medicine that each country needs is vastly different. If anything, Germany probably needs higher interest rates. In Spain, they need lower interest rates.
Tough.
And the ECB
That would be
has
too
to try to
tough
balance all of
medicine.
that.
Way too tough medicine for the ECB to force down the throats of the other countries right now. All right, Brian, thanks very much for that.